Morning to you all. This is a holiday shortened week, as it's called, Easter week. Believe it or not, Good Friday is the only holiday in the US that's guaranteed to be on the same, to have the same holiday in the UK and Europe. You can have Boxing Day, Christmas Day and New Year's Day on different days. They tend, in the US, they have their holiday at the nearest business day. So, for example, if Boxing Day turns up on a Saturday, they'll take the Friday off. Sorry, not Boxing Day, Christmas Day, whereas we take the following business day off. So anyway, Good Friday, that doesn't happen. Good Friday is always Good Friday. It is always off. Lots of news Friday afternoon as well, which makes it interesting. Well, yeah, there is data out on Friday. Oops, that's not the right week. With the PCE data, that's the most, one of the most important releases of the week, actually. Bizarre that it happens on a day when, or the US is on holiday. Anyway, let's crack on. Last week, Paul, can you explain the PBOC's setting of the yuan versus dollar and the impact on the Aussie dollars? People think Aussie dollar could be set for a big pullback. Paul, okay. So you're talking about the yuan, the Chinese yuan versus the Canadian dollar. Are you thinking about the People's Bank of China? Okay, yeah, versus the yuan versus the US, okay, versus the US dollar. Don't know. I've not heard about that actually. I'll have to look into that, Paul. I mean, the Aussie dollar has done particularly well, hasn't it? Bearing in mind of the friction between China and Australia and the spat over all sorts of things. I know their wine exporters have struggled. Not that is of major importance to the Australian markets. It's on Forex Factory. No, okay, I'll have a look into that, Paul. Thank you. Wow, what a week! What a week! Where's the NASDAQ? Where's our friend the NASDAQ? Well, it wasn't just the NASDAQ, was it? Record highs again on the NASDAQ, S&P 500, record highs, German DAX, GER 40, record highs, Eurostock 600, record highs, even our own little FTSE. Look at the FTSE. What are we? I worked it out. I think we were 85 points off our all-time highs that we set, was it February last year? Mid-February last year? Extraordinary. Just extraordinary. Yeah, I mean, extraordinary, bearing in mind we've been making record highs anyway in the S&P and NASDAQ and the European indices. You just who would have thought it at a time when inflation is coming right down and coming down quite hard, it appears, certainly in the UK. But interest rates haven't come down yet. And all these central bankers, as optimistic as they sound, they haven't cut yet. Anyway, FTSE 160 to the good last week, just over 2%. I don't know. Owen says, when's it all going to stop going up? So an interesting article in the Financial Times about the number of share sales by big tech entrepreneurs, the likes of Zuckerberg and Jeff Bezos. And they're quite astute, and they're taking advantage of the hyper valuations on their stock prices, which they are. And the funny thing is, it's just difficult to ignore it. These 7 stocks, the Magnificent Seven as they're called, if you're not invested in them, you are not partaking in this rally. That's it. And if you're not partaking in this rally as a stock investor, a manager, portfolio manager, you get fired. That's it. You've completely miss competing with the indices, and as an investment manager, that's your job, or even to outperform it. So we're all on it, whether you like it or not. So I don't know when it's going to stop going up, but I don't know. Sell in May and go away. Owen? Maybe that's going to happen. But anyway, DAX up 240. That's 1.3%. The Dow had probably one of the not so impressive performances, but it was still up 700 points, about 1.8%. S&P up just over 2%. NASDAQ nearly 3% up. Yeah, articles say natural gas can hit NASDAQ can hit 2,000. Sorry, NASDAQ can hit 20,000. Do you know what, Paul? They can go anywhere. I mean, I remember when I first got into futures, I was a futures trader. The S&P was trading at 250, 300. Look at it now 5,237. I remember being told that a two-bedroom flat in West Kensington at 50,000 was way overpriced and that it should never be there. So value is difficult. Relative value is difficult to gauge. I don't know how our kids are going to afford property prices, but they still keep going up. It's difficult to know. I would have thought sell in May and go away. Seasonal factors do affect our markets significantly, both here and in the US. So that might be a good stopping point. Anyway, US, European, Japanese equities as well. Even look at the Nikkei went absolutely berserk at the end of last week. All on the back of a significantly weaker Japanese yen. All a bit weird, but the Japanese have actually ended their ultra loose monetary policy, and yet the yen collapses. I'll explain a little bit more about that in a second. We also had one surprise as well. We had all the central bank meetings last week, if you recall. If I just put up the calendar from last week, if you remember, we discussed it. We had something like, if you include the the People's Bank of China's 1 and 5 year loan rate announcement, we had 5 central banks policy meetings last week, or policy announcements. And one surprise was the Swiss National Bank, somewhere here, yeah, cutting rates by 25 basis points. Yeah, they do. They do. The Swiss love to be first, says Paul. They sort of do. It's like we're in control. Anyway, they cut their rates by 0.25%, as you can see, to 1.5% from 1 3/4, and that's the first cut for donkeys. So long. I can't remember when they last cut rates. And this follows 5 increases from recollection, and they all started in June 22. They were a bit late to increasing rates, the Swiss National Bank, but they pushed up rates 5 times, concluding the last time they hiked rates was in June 23. Anyway, US, Japanese, European equities all hit, as I said, record territory. And I think it's really down to the fact that investors are really encouraged by the prospects for rate cuts in the coming months, as central bankers, that's the Federal Reserve, they had their meeting last week, the Bank of England, all reaffirmed market expectations. What I mean by that, the Fed said, yeah, we're going to be cutting rates 3 times. And that was quite interesting, bearing in mind they upped growth prospects, and there have been signs that inflation is a bit stickier than they would have liked. So when the Fed said, don't worry, we're still going to cut rates 3 times, you had this real sort of almost a massive sigh of relief. And that's the day that the announcement was made, and the markets absolutely hoofed it. FTSE as well. Just click on the FTSE, have a look at the UK 100. Had its best week since September last year, as we were, as I said, about 85 points from the all-time highs. And they had a good sort of double dose of good news last week here in the UK. Headline inflation. Do you remember we had the CPI reading last week? There it is. GBP CPI, the Consumer Price Index, came in at 3.4%, lower than expected. We were used to be the sort of sick man on the inflation front. Do you remember we peaked at sort of 11.1%, far higher than Europe and far higher than the US. But gosh, down it comes now. And the Bank of England have been saying that it will hit 2% target in Q2. Q2, that's by the end of June. So you really would be expecting interest rates to be cut by then. Anyway, it prompted the Bank of England's governor, a chap called Andrew Bailey, to say that the Monetary Policy Committee was confident that the inflation rate was heading towards its target. And then Bailey also confirmed that rate cuts, I think he said, in play. Yeah, in play. He's quite a chatter, actually, is Andrew Bailey. And he effectively is saying that interest rates were likely to be cut at meetings later this summer. I sort of think later this summer, really early summer, so by June is what's happening. And the bank predicts that obviously inflation will hit that 2% target in Q2, and that prompted interest rate traders. So these are what's referred to as forward interest rate swaps. Banks can buy and sell funds at future dates, and that's how they hedge their loan books, etc. There is now a probability of 60% of a rate cut by 0.25% in June, with a further two cuts of 0.25% by year end. So it's all suddenly looking rather rosy again. And I remember I read an article, I think it was at Lord Wolfson Next, that are close to making £1 billion profit now. Huge success story Next, it really is. So Lord Wolfson, I think of Aspley Guys, as he's called, his official title, he thinks consumer confidence is at a 7-year high. And he really is very bullish about prospects here in the UK. It's just our valuations aren't what they are in the US. Our valuations haven't really changed. Its valuations in the US have just gone nuts, nutty nuts. Yeah. Paul says that, Tories need it as soon as possible. Well, bizarrely, inflation is tumbling like you wouldn't believe. Consumer confidence is improving. Our growth prospects are improving. The Tories are 20 points behind Labour. 20. They're nowhere near. It's almost desperation. And I think, marginal seats, Tory seats, they're pretty much thrown in the towel, and there are so many Tory MPs that are retiring or not contesting the next general election. It's a sign of the times, I'm afraid. Anyway, Federal Reserve also played its part last week. If you remember, we had the FOMC meeting. Normally the sort of most important one, and it is an important one, and they give us all their projections. They give us this dot plot. This is where all the committee members say where they think interest rates are going to be on each quarter over the next 2 years, and it gives us an interesting impression about where things are going. They left interest rates unchanged, as we know. There we go. Federal funds interest rates are of 5.25% to 5.5%. They keep them in bands, actually, in the US. They were unchanged as expected, and they've been there since sort of mid-June last year, really. And it was the Fed that set that. That's when everyone stopped raising rates. We stopped raising rates here in the UK in start Q3, I think it was. Swiss National Bank stopped in June last year. So did the Canadians. So did obviously the US, and they did confirm that they expected, I say they, being the rate setting committee, so that's the FOMC, that stands for the Federal Open Market Committee, and that's their sort of equivalent committee to our MPC here in the UK. And they said they did confirm that they expected to cut rates by 3 quarter-point cuts by year end, but they did actually forecast higher growth, quite a lot higher, 2.1%, markedly higher than anything here in the EU or in the UK, and slightly hotter core inflation of 2.1%, but it's still so much more lower than it was this time last year. But markets, as I said, they reacted so positively. That's actually the UK. Let's just have a quick look at the US. That's the US candle on the day of the policy meeting on Wednesday. And it was after the announcement at 6 o'clock that markets just went ballistic. Bond yields tumbled. a massive risk-on move. Yeah, that's what it is. Into equities, bonds also benefiting, and the dollar also rallying. Not quite the classic risk-on move, actually, but a very positive move nevertheless. And I think expectations for the rate cut in June now. So when you add up the probability of a quarter point cut and a half point cut was about sort of 75% now. And a week ago, if you look at this column here, it was near 55% a week ago. So that's a big, big change in market expectation. The market sort of started the year thinking there were going to be 7 rate cuts, absolutely crazy. That then gradually eroded over the last 5 to 6 weeks to being 3 cuts as the market sort of fell in line with the Federal Reserve's view. But now the market is hardening, is getting a little more, how can I put it, dovish. It believes that there is a very strong possibility of this first rate cut in June, and it's become more of a certainty. Yeah, and I think the jump really is, in equities is down to an improving economic outlook and improving growth prospects, and also improving expectation of rate cuts, which normally don't go always hand in hand. But it looks like the Federal Reserve have done a pretty good job at navigating the economy through this sharp spike in inflation over the last couple of years, and they've created very much a soft landing. It's really is what they call Goldilocks, not too hot, not too cold, for now anyway. Yeah. Currencies quickly. Let's get we can actually have a look at the US dollar index, can't we? You can see that it's very, very clear that the dollar continues to recover versus all majors since the sort of sell-off over the last, started in mid-Feb all the way through to mid-March, and the dollar has recovered quite significantly since then. Growth in the US, that forecast really says it all, really, how well the US economy is doing compared to the Eurozone and the UK, really, although the UK is not the sick man of the G7. It's not the sick man of Europe. And we need to celebrate that, just by the way. Anyway, news that the Swiss National Bank cut rates, the Bank of England also warming to the task of cutting rates, also helped to push the dollar to its highest level pretty much since the beginning of March, really. Anyway, despite ending the ultra loose policy in Japan, the Bank of Japan signaled an increase in rates as the market expected, but actually the yen fell. And this is the number of yen to the dollar, so that is the yen falling, the dollar strengthening. And you ask yourself the question, why, when the Bank of Japan, for the first time since 2016 that they've actually increased rates, why is the yen fallen? And I think this all comes down to expectation. The market expects further tightening from the Bank of Japan, i.e. raising rates by more. If we quickly go to from minus 0.1% to plus 0.1%, doesn't seem much, does it? And you think, well, why is that going to strengthen the Japanese yen? It's symbolic. The fact that they've ended this ultra loose monetary policy, the market expects more. The problem with what happened last week is that the decision to change policy was compromised because there were some dissenting votes in the Bank of Japan against ending the previous negative overnight rate, which, as I've said, has been minus 0.1% since January 2016. And because of that, the yen fell out of bed, 2.4%. And that's main reason, actually, why the Nikkei, and this is the Japan to 225, the Nikkei 225. Why? It went further into record territory. We're at record highs. Yeah. Anyway, there we go. Commodities very quickly. Gold. I know Stuart was talking about these monster candles. I mean, that really is rejection up there, and this is really down to the US dollar. In a way, it's surprising that gold didn't fall as much as you might have expected with the strength in the US dollar versus all the majors, and a fall last week of what, $8. I think it's really modest, quite frankly, compared to the, I don't know, they've sort of rallied, $150 over the last month. I mean, it hasn't held on to all those gains, but it's extraordinary move. And this is all down to Chinese buying, the strength of crypto, although that's very volatile and continues to be so. My suspicions are that gold will struggle unless the dollar does weaken significantly or start to weaken again over the next month. But I think gains that we've witnessed over the last month are unlikely to be repeated. And I think there'll be a bit of backing and filling over the next 2 to 3 weeks as investors take some money off the table. Oil, yeah, sort of bit flat, really. Volatile, but a bit flat, closing sort of slightly higher on the week, but only a matter of a few cents, really. Both UK oil, that's Brent, and US oil, that's WTI. And I think the shift in demand forecasts the previous week from the IEA helped push crude higher. But I think the Middle East conflict between Hamas and Israel, which, I don't know, it just seems to be exposing further rifts between Israel and the US. And it really makes you seem like there's not much prospect for a peace agreement, really, in the short term. Maybe Bitcoin is taking money out of the markets. Oh, and I think that is correct to a certain extent, but I also think the fervor in Bitcoin, I know it was very volatile last week, crikey, but I think that has helped cause gold to rally. It is sort of, Bitcoin has sort of assumed some of the mantle of gold, but gold sort of in a way now follows Bitcoin. It's sort of the tail wagging the dog in a way. But yeah, events this week. Let's get on to that. It's what we call a holiday shortened week, and I think following the deluge of policy decisions from those 5 major central banks last week, we've got a real dearth of releases this week in what is a shortened weekend. But as Paul says, we have got data out on Friday when we're all on holiday, which means Monday will be interesting for US markets and probably Tuesday for us. Anyway, let's have a quick look through onto the right week, I should say. I don't normally look at home sales, but there's not a lot to look at this week, as you can see glancing at the screen. New home sales, it's a quiet week, so it's worth looking at this. The new home sales are a real good indicator of consumer confidence in the US, and the market does follow them quite closely. It's sort of got a medium impact here from Forex Factory. And the data has improved from a low print in December last year, and it's expected to improve further. And I think that really reflects the better growth prospects this year in the US and improving consumer confidence as well. Core durable goods order, I had written this in some notes here, and I've seemed to have missed them. Yeah, core durable goods. Okay, so the core number that excludes transportation items, so some of the big ticket items like planes as well, which really distort the data. Expecting a figure of plus 0.4% in core durable goods, and the dollar will probably be sensitive if there's a significant miss, but if it comes in there or thereabouts, I don't think that's going to affect what's happening in the markets. We've got some data out from Germany, and it was something that the FT was talking about, the GfK Consumer Confidence Survey in Germany, minus 27.7 expected, which is, there's a slight improvement occurring in Germany. It was minus 29 last month, and expectations, consumer expectations, and investor expectations are starting to build and improve in Germany. And as the sort of powerhouse in the Eurozone, the German economy, it's been really hit hard by the energy crisis over the last couple of years. We know that Germany depended on at least 50% of its energy needs from Russia. So it was a massive disruption to their economy. And obviously with the Chinese markets and China really struggling post-pandemic, it has created a lot of problems for Germany. And if the Eurozone economy is to prosper, Germany needs to prosper. Neil, interesting that Nvidia has outperformed BTC significantly. Yeah, it's interesting. It's funny the way people almost compare Nvidia with Bitcoin. It's almost more volatile than Bitcoin, isn't it? And Bitcoin is really volatile, Neil. But I mean, it's just a story that Nvidia, at least it deals with AI, which is a real world benefit. To what benefit, we don't know. But for the time being, when you've got the likes of Meta buying $50 billion worth of chips from Nvidia, you know why that stock is worth $2 trillion. The question is it going to maintain? I just think there's so much good news built into that share price. I'd be reluctant to build a new position in it at current levels, for sure. Okay, consumer confidence. Everyone who knows me will know that consumer confidence is a real good forward-looking indicator. We refer to them as leading indicators. As traders, as investors as well, we also invest our own money, don't we, in SIPs and savings plans, etc. We like to know what's going to happen in the future. There's data that tells us what has happened. That's no benefit to us whatsoever. But consumer confidence is a good one. A steady improvement in consumer confidence over the last few months is evident. We're expecting 106.9 versus 106.7. So not a great change here from the conference board. But dollar and US assets will be slightly sensitive to this release, so that's worth following. Spanish CPI inflation reading on Wednesday. I'm not sure why it's just the Spanish one, but anyway, it is. I think I wrote on my notes, stickier going. I think, yeah, inflation has been a little bit stickier, certainly in the Eurozone and in the US. And it's just remarkable how much it's fallen here in the UK. But we do know that a lot of inflation here in the UK, the core inflation, is down to the service sector prices, which are stickier. And that's something that the Bank of England will be following quite closely before they do start cutting rates. And that's something that economists focus on as well. We've got this chap, Chris Waller, a member of the Federal Open Market Committee. So anything that these guys say in speeches, in events that they're attending, and Chris Waller's attending the Economic Club of New York, and there is a Q&A session with the audience, which is always quite interesting. And in a quiet week such as this, that has got very little data releases, I think this could create some interest. Certainly if there's any reference to future rate cuts. So I would expect the dollar to be just a little bit sensitive to what Mr. Waller says on Wednesday afternoon. Thursday, we got final GDP readings for the US. That's the fourth quarter. We've also got final GDP readings for the UK. And we were talking about leading indicators and lagging indicators. GDP data is very much a lagging indicator. Q4, we know we were in a recession here in the UK. We know what the data was in the US, very strong fourth quarter in the US. And that is telling us what had happened. It doesn't tell us what's going to happen. It doesn't at all. Anyway, it's historical, and I don't expect it to create any impact, although it's given a high impact descriptor. I'm not sure I would be focusing on that too much. We then have the next bit of data that provides interest to me is, again, consumer sentiment. So this time, rather than the conference board, this is from the University of Michigan, and it's their consumer sentiment reading. It's unchanged from the prelim reading, and like I said, insights into consumer confidence and how the consumer is feeling helps inform us about the prospects for future retail spending. And of course, that leads to sort of general growth in the economy. So the dollar is sensitive to that reading. We then have Friday, Good Friday. All major international markets are closed, including the US. But you will note that the core PCE, the Personal Consumption Expenditure, which is the preferred measure of inflation that the Federal Reserve uses rather than the CPI reading that the US produces. This is just the Federal Reserve's own penchant, so it is something that the markets watch very closely. Of course, the markets are not open, so there'll be absolutely no way that you'll be able to articulate any opinion about this release on Friday until Monday. Please remember, it is a bank holiday in all international markets on Good Friday. On Monday, it is also a holiday, but only in Europe and the UK. So next Monday, we will not be having a workshop, the sniper review, because the markets will be shut, but they are open in the US. So please remember, US markets are open. Finally, yeah, it could create some carnage. I mean, we've had this before, Owen, where we've had non-farm payroll out on a ruddy holiday. I mean, it is probably one of the most important releases of the month, and the markets are closed. So yes, it could create some carnage, although the PCE, yeah, I mean, it depends on if it misses by a decent amount, that will create quite an impact on Mondays. And of course, here in the UK and Europe, we're going to have to wait until Tuesday to react to that data on Friday and anything that happens in the US on Monday. And please also remember, EU, UK clocks go forward on Sunday by an hour. So that'll then restore the 5-hour difference between us and the US. So we will go back to the regular close at 10 o'clock. So please bear that in mind. That's it, really. 22. Yeah, I've waited on a little while, haven't I? Anyway, there's a reasonable amount to talk about, mostly from last week. The calendar this week is pretty sparse, I'm afraid, but tends to happen after a very busy one. But yeah, markets just look unstoppable. Something will stop them. We don't know what yet, though. If we knew, it would be a different kettle of fish, wouldn't it? Yeah. Good stuff. Everyone, please have a good rest of the week. Enjoy your long bank holiday weekend, Friday and Monday off. So, yeah, just have a restful, peaceful Easter break. And thanks very much for listening and attending. Yeah, everyone have a good rest of the week. Bye for now.